As you hold your newborn in your arms, your mind may already be buzzing with plans for their future, including how to finance their college education. As the years go by, you want to ensure they have the best education possible, but how will you pay for it? One popular idea is to buy a home as an investment and sell it when it's time for college tuition. But before you jump into the real estate market, let's look at the facts and figures to determine if this is a wise financial decision. Today's report is a comprehensive examination of buying a median price home, leasing it until your child turns 19, and then selling the home to generate the cash needed for your child's education. We have chosen to prepare our analysis around a median-priced home in Tallahassee. This relationship between price and rent is very similar to many other U.S. housing markets. So if our prices seem low or high, it will all work out with the local rents. In Tallahassee, the median existing home price is $255,000, while the median new home price is 93% higher at $492,000. The overall median home price in Tallahassee is $280,000. Our case study examines the investment strategy of purchasing a home when a child is born and selling it to fund college expenses when the child reaches 19. We base our analysis on the median existing home price of $255,000. As an investor, I typically favor existing homes over new homes due to the huge price difference. New homes do bring the benefit of lower operating costs for the first 10 years, but I like the large discount to cost that I get when buying a used home. For financing, the typical investment loan will cover 80% of the purchase price, and we've included an expected 3.5% in closing costs to purchase the property. Here is how that settlement statement would look. With a purchase price of $255,000 and another 3.5% in closing costs, or $9,000, the cost of acquiring a median price home in Tallahassee is just under $264,000. The loan will cover $204,000 of that, so we need to bring an investment of nearly $60,000 to the table to buy this home. Remember, our goal is to convert this $60,000 into a college education for our child 19 years from now. So I checked the Vanguard College Cost Projector to find that in 19 years, we should expect to need between $250,000 and $350,000 to send our child through 4 to 5 years of school. If you're a longtime subscriber, then you know I often answer frequently asked questions in real estate because most of the answers you find online are loaded with hidden agendas. Please keep your questions coming. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts, and ignore the hype that is so prevalent online, then subscribe now and I'll keep you in the know. This report shows how we would convert the house to cash to pay for college in the year 2042. In order to produce this analysis, I had to make some assumptions. To estimate a future sales price, I used the 60-year average rate of home price growth in the U.S. to calculate a sales price in May of 2042. In reality, the rate of home price growth has been rising over the past 30 years, so I suspect this future sales price is conservatively low. I also had to make some assumptions on taxation and closing costs, so I used today's figures. In 2042, the median home price in Tallahassee will be just under $720,000, so our sales proceeds after paying closing costs and satisfying the loan is around $533,000. After calculating a capital gain of nearly $545,000, our cost recovery of $37,000 and capital gains tax of $60,000 results in after-tax cash proceeds of $437,000. Simply put, the $60,000 invested today will equate to $437,000 in 2042 that you can spend on your child's education. That seems pretty darn good, right? So many people are peddling real estate investment courses online that it's easy to get confused about wise investment strategies. Unless you're looking for a job, the safest way to invest in real estate is to buy and hold. As soon as you hear the term flipping, run away. While people can make good money flipping homes, they aren't doing it passively. For them, it's more than an investment. It's also their job. Flipping real estate is a job where you'll compete with other people who do it full time. If you think you can work a full-time job and flip real estate on the side, you will soon find disappointment. The best deals will go to people spending 60 hours a week searching for deals, so you'll be left with the flips they didn't want. But a long-term hold investment where you own real estate for years without selling is something you can do passively by hiring a manager to handle the operation of the property. You gain very strong returns by leveraging, which means using borrowed money, such as a mortgage, to purchase a property with the expectation the property's value will increase over time. The goal of leveraging is to increase the potential return on investment by using other people's money to fund the purchase. In this investment, we used $59,900 to control a $255,000 asset that grew by 5.6% annually. Instead of merely gaining a 5.6% annual return, we converted that to an after-tax return of more than 13% using leverage. But there's still a piece missing. We also need to consider the property's annual cash flow. We're optimizing the growth of leveraged depreciation by borrowing at a 4-to-1 rate on this property. So doesn't that mean cash flows should be pretty tight? This chart is a year-by-year analysis of cash flows, including a what if for a sale each year. Prior to the sales proceeds, at the bottom of each year, you can find cash flow after tax. It's the section that includes an additional reason for buying a home as an investment. See if you can spot it before I point it out. In order to understand what the pro forma income statement is telling us is by evaluating several different years. We'll start by looking at our first full calendar year of ownership in 2024. Then we'll look at 2033 to see what the halfway point looks like. And then finally, we'll focus on 2042, the year we sell the home. Moving down the 2024 column, we see gross income at $24,630, but after expenses, we end up with nearly $19,000 to make our mortgage payments. After all is paid, we have a net operating cash flow of nearly $1,700. Now for the fun part, and a great reason to own investment real estate. Let's calculate the tax liability created for the $1,700 received in 2024. As we apply expenses to our gross income to calculate taxation, you'll notice there's a $7,696 line item expense called depreciation. I love depreciation. Did you know the IRS lets you write off depreciation, meaning reduce your taxable income with depreciation? According to the IRS, residential real estate investment depreciation deducts a property's cost over a specified period of time for tax purposes. It's an allowance for the property's wear and tear, deterioration, or obsolescence that occurs over time. The IRS allows real estate investors to depreciate residential rental properties over 27.5 years, which means investors can deduct a portion of the property's value each year as an expense on their tax return. The depreciation deduction can help reduce the investor's taxable income and lower their overall tax liability. The case study example includes an annual write-off of $7,696 for depreciation. This is not money you've spent, rather it's an amount of loss in value that the government expects on your property. If you hate paying taxes, depreciation becomes your new best friend. Looking at 2024, we see the tax shelter people often reference when discussing real estate investment. The taxable income and taxes show that while we earned a positive $1,697 in cash flow, we got to report to the IRS a loss of $4,068. Simply put, we made money, but we reported a loss to the IRS. This means they sent us some of our income tax back. For our report, we just carry forward the loss each year. You can see that by the end of 2027, we've reported losses of about $24,000, even though our cash flow has been slightly positive. When we move ahead to 2033, that's when it gets interesting. Two lines will help you understand the benefit of depreciation write-off. The first is cash flow before tax, which is the amount of money your property manager sends you, and the second line is ordinary income. Your taxes are based upon ordinary income, and you can see, thanks to depreciation, your ordinary income is negative until 2033. Your first 10 years put tax dollars back in your pocket, and the final 9 years have you paying lower taxes than you would if you received the income from another type of investment. In our analysis, we carried forward the losses from previous years instead of deducting them annually, which is the usual practice. By doing so, we have delayed the creation of income taxes until the year 2040. Depreciation is a valuable tool that real estate investors can use to reduce their taxable income and lower their tax liability. Overall, by taking advantage of depreciation, real estate investors can enjoy increased cash flow before tax and reduced ordinary income tax liability, making it an attractive investment option for those looking to build long-term wealth or send their child to school. So, should you buy a house for your child? Absolutely, and buy a few for yourself too. One thing I explain to young investors all the time is that smart real estate investing, buy and hold, is boring. The type of property you should target is boring. If you're excited about a property you're about to buy, you're probably making a mistake. Great long-term hold investments are just regular houses in the right areas. Nothing sexy, nothing crazy, just go out and buy houses where the middle class wants to live. The safest place to be in the housing market is in the middle. Should any market correction come around in the future, the homes that stay occupied are the ones in the middle. Low-end units often have relatively high rents, high vacancy rates, and collection issues, compounded with high turnover costs between tenants. On the other end of the spectrum, high-end units often have relatively low rents and are the first to go vacant in an economic downturn. Buying homes in the middle two quartiles of a housing market is the safest way to ensure a long-term investment in the housing market. If you want to learn more about a smart, long-term, residential buy and hold investment plan, you can leave a comment or drop me a direct note at the link I've left below. Are you curious about what's really going on with foreclosures and loans and forbearance? With ignorance dominating the news cycle, it's tough to get an accurate picture of the state of the housing market. That's why I published this new report on what the numbers say about foreclosures and forbearance. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.